It was the new American dream, forged not in steel or on assembly lines, but in lines of code. A world where your money could make money while you slept, not at the paltry 1% offered by a bank, but at a staggering 200%. This was the promise of DeFi, decentralized finance. It wasn't just a new way to invest. It was a revolution, a promise to free our finances from the grasp of Wall Street and the old guards of money. But as thousands of investors would soon discover, when a promise seems too good to be true, it's often because it's hiding a devastating secret. A secret that would unravel a system built on faith and reveal that the ghosts of the old financial world were haunting this new digital frontier all along. The year is 2021. The crypto bull market is in full swing. A new term is on everyone's lips. Yield farming. It sounded agricultural, almost wholesome, as if you were planting digital seeds and harvesting returns. Protocols with exotic names like Bigordio, PancakeSwap, and SushiSwap were offering yields that made traditional savings accounts look like a joke. The most seductive of them all was a protocol named Anchor, built on the Terra blockchain. It offered a seemingly stable 20% annual percentage yield on a stablecoin. A cryptocurrency pegged to the US dollar, it was the holy grail, the high returns of crypto with the supposed safety of cash. For a while, the system worked like magic. You'd deposit your money, and every day you could watch your balance grow. It felt like you'd found a cheat code for the financial system. Influencers and so-called crypto gurus flooded YouTube and Twitter, evangelizing this new paradigm. They painted a picture of a decentralized utopia, a world where banks were obsolete and financial power was returned to the people. There were no pinstriped bankers, no mahogany boardrooms, just an algorithm. A protocol that was fair, transparent, and infallible. Users poured billions of dollars into these systems, convinced they were part of a financial revolution. They weren't just investing, they were believers in a new faith, and the 200% API was their daily miracle. But behind the slick user interfaces and the promises of a decentralized future, a much older and more dangerous game was being played. Our investigation began by asking a simple question that few seemed to be asking at the time. Where was all this money, this incredible yield, actually coming from? The answer, buried under layers of complex code and technical jargon, was profoundly disturbing. The high interest rates weren't magic, they were a marketing budget. Venture capital firms and project founders were subsidizing the yields to attract a flood of user deposits, creating a temporary illusion of impossible profitability. The system needed constant new money to pay the old money, a classic playbook for financial disaster. When we started tracing the flow of funds, the promise of transparency quickly evaporated. The user deposits weren't sitting in a digital vault. They were being put to work aggressively. These DeFi protocols were acting like unregulated, hyper-aggressive hedge funds. Your deposit into one protocol was often loaned out, then used as collateral to borrow from another, which was then staked in a third. All in a dizzying chain of transactions designed to chase ever higher returns. Each layer added risk, but it also added a layer of anonymity. The on-chain data showed a labyrinth of interconnected smart contracts and anonymous wallet addresses. A digital house of cards where it was impossible to see who was holding what or how leveraged the entire system had become. This wasn't decentralization, it was obfuscation. The first major tremor came with the collapse of the Terra Luna ecosystem, and with it, Anchor Protocol. The stablecoin that was supposed to be safe lost its peg to the dollar, and in a matter of days, $40 billion in investor value vanished. The panic was immediate and brutal. As users rushed to withdraw their funds, the intricate web of reinvestments began to tear apart. But this was only the beginning. The shockwave hit so-called centralized crypto lenders like Celsius, which had presented itself as a safer, more user-friendly bridge to the world of DeFi. Celsius had promised its users high yields, claiming it was simply lending out their crypto to institutions. The reality was that Celsius had been one of the biggest yield farmers of all, recklessly gambling customer funds in the riskiest DeFi protocols, including Anchor. When the market turned, Celsius froze withdrawals, trapping hundreds of thousands of customers and over $12 billion of their assets. Their CEO, who had once worn a shirt that said "Banks are not your friends," was now acting like the worst kind of Wall Street villain, locking the doors while the building burned. The illusion shattered completely. These weren't decentralized, community-owned projects. Many were controlled by a small handful of anonymous founders and venture capitalists who held special governance tokens that gave them ultimate power. They could change the rules, halt the system, and control the flow of money, all while hiding behind the veneer of code. The collapse of Anchor, Celsius, and other anonymous funds wasn't a failure of an algorithm. It was a failure of human trust, amplified by technology that made accountability almost impossible. From a forensic perspective, this new world of DeFi looks eerily familiar. It's the ghost of Wall Street's shadow banking system, the same network of opaque financial instruments and off-balance sheet vehicles that led to the 2008 financial crisis. But this is shadow banking 2.0. In 2008, you could eventually find the buildings, the offices on Wall Street where the bad decisions were made. You could subpoena executives and trace the paper trail, however convoluted. In this new world, there are no real addresses. The headquarters is a Discord server. The CEO is a Twitter pseudonym. The vault is a string of hexadecimal code. It's a system where a fund controlling billions of dollars can be run by 3 anonymous individuals, known only by their online avatars, operating across different continents and legal jurisdictions. When these systems collapse, who do you serve the lawsuit to? Who do you hold responsible when the founders simply disappear, their digital identities vanishing like smoke? We saw this with the Quadriga CX exchange, where the founders' supposed death locked away hundreds of millions in customer funds. We saw it with countless rug pulls, where anonymous developers launched a project, attracted investment, and then drained the liquidity pools, disappearing forever. This is the dark side of anonymity. It creates a perfect environment for the oldest financial sin of all: greed. The technology, which promised to eliminate the need for trust, ironically demanded a blind faith that was even more dangerous. The core lesson is as old as markets themselves. Decentralization doesn't eliminate greed, it just makes it harder to find. It doesn't erase the human impulse to take shortcuts, to chase unsustainable returns, or to exploit the trust of others. It simply provides new, more powerful, and more anonymous tools to do so. The dream of a completely trustless, decentralized financial system that can self-regulate and protect its users from harm remains, for now, a dangerous illusion. The code might be neutral, but the people who write it, control it, and use it are not. And without accountability, without a name and a face to attach to a promise, any financial system, no matter how revolutionary, will eventually be haunted by the same ghosts of greed and fear that have brought markets crashing down for centuries. The future of finance may still be written in code, but its story will, as always, be a human one.